Nvidia alone trades 30, 40, 50 billion dollars a day. When he then converted SAC into 0.72, and he was back trying to raise money for 0.72. It was a famous thing where, he raised almost $5 billion without taking a plane. I think the real success, or the reason for his success, was not necessarily only that he was a good investor, which I think he clearly was, given the returns in the early days of SAC. But I think after that, he was actually, he has a characteristic that is very rare in the industry, which is he's been extremely good at actually delegating and actually building a business, a team out of that then repeats a certain task successfully over and over and over again.
I've heard many venture capitalists and startup founders, or people who've worked for unicorns in the startup world, say very similar things. They've said, you can't afford to do that. You're unable to scale as a leader unless you delegate. You find the best people, you hire them, and you get out of their way. And I think a lot of startup founders struggle with that. And it sounds like even in the investment world, those rules can apply.
Yeah, it's always the same, right? Find a model that works and then find ways to be able to scale it, right? I mean, if you can't scale something, then you don't have a business model. We are, for example, extremely cautious when we see startups in the region here, for example, that come to us and they say, I'm doing XYZ in Dubai, and and then they'll go to $300,000 of revenues, basically, something very small to just kind of prove their actual MVP, basically, right? Minimum viable product. And then before scaling in Dubai, they'd be telling us, we're now going into Saudi. No matter what your business is, doing $200,000-$300,000 of revenues is not you having any sort of
real business.
Real market leadership in any business that you've had the idea of. We have even families there that will be like, I don't understand digital assets. I don't believe in Bitcoin. I think it's all Fugaza, whatever. But I might be wrong, so I'm going to invest. And generally, these are obviously the best investors.
So these old conservative family offices, they are actively investing in crypto.
Yeah, they are. And I think more so now, especially given that, post-Trump's election, it's kind of become kosher, so to say, to be in digital assets.
How would you describe the difference between the startups that would traditionally go and get venture capital funding versus one that would go to family offices for funding?
Yeah, I think the reality is that...
Hey founders, ready to match with your next investor? At lucidityinsights.com, we've built the Middle East's first Tinder for startup founders and VCs. Explore 800 verified VC and angel profiles, see who they're funding, and send your pitch deck directly, all in one place. Stop waiting for introductions. Make your own luck at lucidityinsights.com. And for a limited time, get 20% off your startup registration with the code TPP20 at checkout.
Hello, and welcome to this special episode of The Perfect Pitch. I'm your host, as you know, Erica, and I'm sitting across from Muhammed Yesilhark. He is very special because he's an investor through and through. Muhammed, I'm really, really grateful to have you here.
Thank you very much for the invite. It's a pleasure to be here, Erica.
Probably about a month and a half ago, you and I sat down with the Dubai Chambers podcast that I also help host. And I just couldn't get enough of our conversation. So I'm really excited for you to be here today. If some people are wondering why you're sitting here, because you're not an actual venture capitalist, which I normally sit across from, I want to just say you are a former hedge fund manager. You've worked in the equities markets. You are also a crypto investor, and you actually worked for a crypto fund for a while, which I want to dive into. But now you manage a multifamily office where you're representing some of the wealthiest families across Europe and funneling some of that money, not a lot of it, I think, but some of that money into startups in the region and around the world. We're going to get into that startup investing in a moment, but I want to talk about your hedge fund experience, because I think there's a lot of investors out there and startup founders who've never had the opportunity to sit across from someone like you. So I want to start off with, what is a hedge fund manager? How did you cut your teeth in investing? What does that everyday life look like for a hedge fund manager?
I'm happy to start there. On the hedge fund side, the first thing I would want to say is that there is no such thing as a hedge fund or one specific group of hedge fund guys, because hedge funds, the term is like vegetables. There is all sorts of different hedge funds, different strategies, different aims, different backgrounds, and different applications of that strategy. And you can't compare the people that are doing the same thing, and you can't even transfer the skill set. So as someone that is doing high frequency trading to someone that's doing fundamental long short, these are two completely different executions of some sort of absolute return strategy. One guy would be running, would have guys that would just be coding basically in front of computers, completely silently, and trying to, high frequency trade the market, so to say, in very, very huge frequency. That's why it's called high frequency trading. Their average investment period would be like seconds or, milliseconds even, depending on their strategy. Whereas someone that's doing fundamental long short would be a guy that meets management teams, tries to understand businesses, and really is looking at a completely different type of investment style. His holding periods might be months, some in years, basically, right? So you can't compare, it's both in the term of hedge funds, but you can't compare the two strategies or the two skill sets. Neither can you transfer them basically to each other.
After the last time we spoke, I actually went back and looked, and I started watching a couple documentaries on hedge funds and where they came from. My understanding is that it's actually a relatively new field that really came into prominence in the 80s or 90s.
Yeah, 90s, yeah.
I
would say the 90s, yeah. So 1988, 1989, 1987, 1986 were generally the years where hedge funds were founded in the US.
And the whole idea was there was a bunch of investors that said, actually, I can start a small fund on the side that, as the name suggests, can hedge against all other investments. So it's like you said, it seems you can trade in anything in hedge funds.
It's really more, Erica, that the prominence of the ability to short sell and to make money from falling stocks as well as from rising stocks. As that kind of emerged in the 80s, managers or people came up with the idea to say, okay, wait a minute, why can't I come up with some sort of an absolute return strategy while using the equity markets, basically, so that I can tell people, look, whether it's a good day or a bad day, whether it's a good year or a bad year, my strategy should make you an absolute return, right? That's obviously, you're not going to be as strong as when the markets are in a bull market, and they will be rising significantly. But at the same time, when they fall a lot, then your investors also don't expect you to lose as much, basically, right? That's where the term absolute return comes from, right? The idea of trying to make a smaller but more consistent return year in, year out, basically.
And how is that different? Like, that makes perfect sense to me. How is that different from what investors were doing prior to hedge funds?
I mean, which they are still doing now, right? It's called, the public market investing space is divided in long-only community and the hedge fund community, basically, right? Or the alternatives. I mean, the hedge fund community is underneath the bracket of alternative investments, basically, which is also where private equity is or venture capital is, etc. So on the long-only community, you give the manager, if you're using a manager instead of an ETF, you give the manager the capital, and he invests the capital according to his strategy in the markets, but he's always invested. He'll be nowhere less than 95% long, basically. He'll just be always invested, and if he's bearish, he'll have 3, 4, 5% of cash, basically. But he'll still be 95% long the market, because his benchmark is the underlying index that he needs to beat, basically. Whereas on the hedge fund side, he doesn't have to be invested, and he doesn't have to be 100% long either. So he can be 200% invested, meaning 100% long, 100% short, but his net exposure to the market might be very close to zero, basically, right?
Interesting.
So it's a very different approach to investing, actually, right? One just gives you participation in equity markets and the upside thereof. One is actually an absolute return strategy that is trying to make money from the equity markets, but technically should have very low correlation to the underlying indices of the performance of these equity markets.
Interesting. I asked ChatGPT how it would describe hedge fund managers, and they said it was the extreme athletes of investing.
Yeah, I mean it's considered that way. And my ex-boss Steve Cohen famously said multiple times that it's not a sprint, it's a marathon. He used to say that. What he meant by that is, in equity markets, especially in emerging markets, you have a lot of guys that are looking at this as this quick scheme to just get wealthy very quickly. So you'll have all these zero-day options, all these leverage guys that would try to, bet big time into one single name and then hope that they will make life-changing money, basically, literally almost overnight, right? Or in a matter of days and weeks. And whereas in reality, equity markets are there to find to give the ability for companies to raise capital and to have the ability for the masses to participate in the success of extremely successful companies, basically, right? Which is why they go public in the first place, right? So importantly, you should look at equity markets always as a long-term investment vehicle, basically, right? Rather than trying to find it as some sort of speculative ground for the day or for the week. I mean, they move a lot, but still that doesn't mean that's the only way of investing.
The average person should be looking at it long, but you're saying hedge fund managers, they look at everything. They look to long, short.
Correct.
Which is why perhaps it's more of the extreme sport.
Yeah, and it's at any point in time, Erica, you need to think of it this way, right? At any point in time, there are hundreds of millions of people. At any point in time, that are investing in the public markets, that are looking at the news, that are looking at everything that is going on the prices and on the volume and the articles that come out, etc., and are trying to figure out what's happening and are trying to make investment decisions on the back of that, right? I mean, think of it, right? Nvidia alone trades $30, $40, $50 billion a day, basically, right?
Wow.
So there is a lot of people, trying to make money, game the system, whatever they can to actually, make a living out of that, basically, right? Whether they do it as a hobby or whether they actually do it professionally. So it's extremely unlikely for anyone to be successful at this consistently unless they are at the athlete level, like you mentioned, right? It's like saying, I just play football every Saturday and I'm hoping that next week I'll start in the Premier League. Like, it's very unlikely that you'll be playing Premier League level football if you just play on Saturdays with your son, basically, right?
Right.
So it's the same. Like, there's hundreds of millions of people, probably, I'm not sure about the number, but that are playing football or that are keen on football, but there is only, whatever it is, 25 times 20 teams football players that are like 400 or 500 Premiership players, basically, right? That are out there.
Let's talk about that, because you dropped a name earlier, Steve Cohen, who you worked for in, I believe, his London office. And I also looked him up after our last conversation, because before I sat down across from you last time, my introduction to hedge fund managers was the HBO show Billions, which I was obsessed with 7-8 years ago. And you serendipitously, you mentioned that Damian Lewis's character, the head character off of Billions, was actually formed sort of on the backdrop of your former boss, Steve Cohen.
Yeah.
And so, of course, I went home and watched as many documentaries as I could about this Steve Cohen character, and I was like, I need to understand this guy. So arguably, you might be able to say that you were in the Premier League of hedge funds working for him. And I say that because normally in hedge fund and in most funds, there's this 2% management fee, and then they get 20% return. And my understanding is Stephen Cohen was such a shark, so good at the game, that he charged a 3% management fee and a 50% return on profits, which is crazy. I don't think anyone could say that they could do that today. And he did that for over 20 years, it's my understanding. And so I'm curious, what was your experience like working for the shark of all sharks in hedge funds in London? I don't know how much he managed in the end, but people would say, people were willing to give away half of their profits, each year because he was so good. And I believe for most of those 20 years from 1992 to 2013, he and the fund that you were a part of was returning on average 30% returns, which is also unheard of today.
Yeah.
What do you make of all of that?
Yeah, I mean, I think it's clear that you have done some of your research. I can see that very clearly. So you're right. So Steve is definitely one of the legends in the space. He's built a business that at some point at days was trading single-digit percentage of the Nasdaq volume, basically,
Wow.
right? So that is an extremely impressive track record, as well as an extremely impressive result, basically, of having a firm that can become that successful. I think the real success, or the reason for his success, was not necessarily only that he was a good investor, which I think he clearly was, given the returns in the early days of SAC. But I think after that, he was actually he had a characteristic. He has a characteristic that is very rare in the industry, which is he's been extremely good at actually delegating and actually building a business, a team out of that then repeats a certain task successfully over and over and over again, basically, right? At the years when I was in SAC, from 2009 to 2013, Steve was less than 5% of the capital that was being managed, basically, at any point in time. So the returns were actually coming from all the 100+ portfolio managers that he had hired, and that he had given the tools necessary, the training necessary, and then the risk management metrics necessary for them to be successful at their game. And the hack that he had was, people are trying to charge on average 2.20, although in the 2000 post-financial crisis, the rate started coming down. The average rate was more at the 1.3 and 16 level kind of thing, more or less, of the industry. And what he was basically doing is he was finding those successful managers, and he was basically telling them, don't go and set up your own fund. It's too much work. There's all these regulatory stuff, and you have to go do fundraising. None of you guys like to go around and try to explain to people why they should invest in your funds, etc. Just come and work for me. You don't have to be in front of anybody. I'll give you the capital, basically, and you can just do what you like, what you're good at, basically, which is investing, right? So he found people like myself and others, and he would give them the capital, and he would give us economics that are very close to the 2.20, basically, right? So it almost makes it not worthwhile to go and start your own firm, basically. And to be able to do that, he had to charge more. So he was charging, the average was around 3.5 and 35, but there were periods where he was charging 3.50 as well, you're right. But I was invested in the firm with my capital and my deferred capital. And throughout the period, I paid 3.25.
Wow.
And I still got 25% annualized return back.
Wow.
Post fees.
Wow.
Right?
Wow.
And then when I was complaining all the time and saying like, oh, why am I paying, 3.25 on the money that I'm also managing myself?
Yeah.
They were basically saying Steve is paying the same. So that was the rule in the firm, basically. Because obviously there was a huge amount of investment going on into the risk management systems, into the internal tools, basically, to allow the fund managers, the portfolio managers, to be very good at their game, right?
I love that.
That's why, the fees had to be higher. But from an investor's perspective, who cares, in a sense?
You're still making more.
If you're still making
than you went.
more than the average, out there in the industry net, then you'll be able to you'll be willing to pay these fees, basically. Which why famously he also got famous about when he then converted SAC into 0.72, and he was back trying to raise money for 0.72. It was a famous thing where he raised almost $5 billion without taking a plane, basically. Like without having to go around.
That's how powerful his Rolodex was.
Yeah, exactly.
That sort of golden nugget that you've pulled out of what his leadership style and what his key to success was, because I've heard many venture capitalists and startup founders or people who've worked for unicorns in the startup world say very similar things. They've said, in the early stages of a startup, often leaders tend to micromanage and get their fingers involved in everything else. But as a startup has to scale, and especially as we talk about becoming a unicorn, you can't afford to do that. You're unable to scale as a leader unless you delegate. You find the best people, you hire them, and you get out of their way. And I think a lot of startup founders struggle with that. And it sounds like even in the investment world, those rules can apply.
Yeah, it's always the same, right? Find a model that works and then find ways to be able to scale it, right? I mean, if you can't scale something, then you don't have a business model, right? So that's always the same. That's why we are, for example, extremely cautious when we see startups in the region here, for example, that come to us and they say, oh, I'm doing XYZ in Dubai, and and then they'll go to $300,000 of revenues, basically, something very small to just kind of prove their actual MVP, basically, right? Minimum viable product. And then before scaling in Dubai, they'd be telling us, oh yeah, we're now going into Saudi, or we're going into Qatar. We had even one company that was telling us that they're going into Thailand, and we were basically, okay, but you haven't even scratched the surface of the UAE, and now you're already telling me that you need to go into another larger market, basically, right? Either your model is not proven, or you're just trying to keep the story alive so that you have a reason for people to throw more money at you, basically, right? On something that actually you haven't cracked yet, basically, right? So
let me ask you that, though, because a lot of startup founders might say, okay, if I've got 300,000 revenue from one or two countries, then isn't that already a strong proof of concept? I've got traction and I want to stay a leader in the game. When is the right time to go global? Because a lot of venture capitalists in the region, they're looking for those that can be a unicorn, right? And a part of that is also being first mover advantage in some markets. And there's this question of how to scale. Of course, there's multiple strategies for that. But you're telling me, 300,000 revenue, maybe you've got some sort of business model in the UAE. That's not enough. What is enough?
I'm not stuck on the number, basically, that I'm saying 300,000 is the revenue number, that's not enough, etc. I'm just saying no matter what your business is, doing $200,000-300,000 of revenues is not you having any sort of
real business.
Real market leadership in any business that you've had the idea of, basically. I mean, a good restaurant in Dubai makes more than that easily. I mean, there's restaurants that make $1 million a month, basically, right? So there is really that's really what I was trying to get to, basically, right? Be honest to yourself and be honest to say, okay, this was my idea. This is what I thought was going to come out of it, basically. Am I really, have I really now, gotten to the end of this market here for me to justify and argue that, I've already been very successful and now I'm going to take this and replicate it in Saudi or replicate it in, XYZ market, in Jordan, in other countries. That's what I meant, basically.
Okay.
Right? Yeah.
Hey, if you really enjoy this content, then please don't forget to like and subscribe. And if you want to know more information about any of the startups or investors that we covered, then go to www.lucidityinsights.com and look for the startup and investor databases that we've developed for you there. There, you can go and look up whichever investor you're curious about, search for them, find out what their average check sizes are, who's on their team, how many companies they've invested in so far, and you can do your research right there to see if they might be a strategic investor for you. For startups that you're interested in understanding their fundraising journey, you can go and check out our startup database. You can look up any startup in the Middle East and Africa. There's new ones being added every single day, and you can check out what their fundraising story is. And if we've recorded a podcast with the founder, you can find that there too. Hope you enjoy. So let's talk about you being the Chief Investment Officer at NOIA Capital. I believe you have sort of these three income streams. There's a lot of startup founders that say, yeah, I want to go talk to family offices to invest in me. But it's a very different investment vehicle to, a startup approaching an angel or even a venture capital. How would you describe the difference between the startups that would traditionally go and get venture capital funding versus one that would go to family offices for funding?
Yeah, I think the reality is that I think people that have ideas, they have basically exploited their friends and family for their angel rounds, etc. Generally, they will try and get capital from whoever they get connected to and whoever they find understands them, understands their business, and can relate to what they're trying to achieve, basically, right? So I don't think necessarily that, from our experience, that those guys are making that much of a big difference to say, oh, these guys are a family office and these guys are a venture firm, etc. They're much more, it's a people's business at the end, right? If people sit across you and they like you and, you know, they feel like you understand what they're trying to achieve here, then they'll be very willing to take your capital, basically, right? That's my personal experience, basically. But that's also because every investment that lands on our desk, we ask ourselves, why is it on our desk? Like, because obviously we're not trying to compete with the venture firms or with the growth capital private equity firms. We're not. There has to be a reason why something lands on our desk, basically, right?
And so what are some of those reasons?
Yeah, so it's more of the complex end of things that are around in markets overall, basically, of opportunities out there, right? Generally, for example, it'll be situations where a pure play venture capital firm or a pure play private equity firm would just not look at it, basically, at that investment specifically, right?
Why?
Just because of the way the conditions have emerged. I'll give you examples and then it'll be much clearer, basically, right? Things that would land on our desk would be, Series A plus round, had either a venture firm or a large angel guy supporting the company from pre-seed to seed to Series A, and then for whatever reason, that person couldn't support the company anymore. Now the startup that was relying on that check, basically, or on that funding source, all of a sudden is in jeopardy, and their business is doing well, but there's a problem on the cap table, basically, right? And that's not a reason for any venture capital firm necessarily to say, oh wow, let's have a look at this, basically, right? But it's a very good reason for us as a family office to say, okay, can we jump in here?
Why?
And can we plug the capital and then sort the problem and then basically have a seat at the table, basically, right? Because those are because their jobs generally is to identify the businesses from the beginning, right? Depending on where you are in the cycle. And then find the clean stories that you can find and invest in, basically, right? Whereas that's not where we want to play, where we're trying to compete, basically, right? And we can't, because we're never going to be as good as they are in sourcing. Because we don't have the depth of the team to basically set it all up, to make sure that we can see the best founders, etc., all the time. What we're rather looking at is more from the network that we have built, right? And for people to say these are reliable guys, and they're fast to execute. They have low hierarchy in decision making, basically, right? So they can really go from looking at the asset to writing a check within weeks, basically, right? And therefore we should talk to them to see if we can find a solution. I'll give you another one. When we acquired Improbable's defense business, basically, right? That was a company that's renamed now to Skyroll, and that was around 2 years ago in the UK. Improbable was a company that had raised $1.2 billion from massive firms like
1.2 billion.
1.2 billion from firms like A16Z, SoftBank, many other companies,
the
and
big
family
hitters
offices. Exactly.
in the venture capital space.
The company was founded in 2013 or 12, if I remember correctly. And then in 18 and 19, had these extremely large rounds. And then in 2016, they had built already the AI simulation product for the enterprise and the defense sector, basically, right? That they had started that in 16. But in 21, at the end of 21, in 22, they couldn't, if you remember, NASDAQ had a 30% drop in 2022. So they weren't able to get the follow-on investments from their investors, basically, in 2022. So they required capital again. And at that time, that was it when Improbable Defense then decided to spin off their defense unit, right? To either close it or to sell it, basically. And which is where we came in, and we acquired it. But we had no competition in acquiring that business, really. The reason being is because no venture capital firm or private equity firm can go into a transaction where you have uncertainty, because it's a regulatory uncertainty. The government needs to approve a transaction, basically, right? That that this new buyer can own this asset, etc. So in this industry, from that context, it's extremely difficult for a venture capital firm to go to its LPs and say, I'm putting X amount of dollars into an escrow account to ideally, hopefully, inshallah, acquire this asset. And if I don't get the approval, then my money is gone, because the seller was adamant to say, I'm not taking that risk, you're taking that risk, basically, right? Because I know I own the business, you want to acquire the business. So if the regulatory approval does not come in from number 10 in the UK, then this is not on me, that's on you, basically. So no real, unless you're a family office and you're dealing with your own capital, you can't take these type of risks, basically, right? And that gave us obviously the opportunity to, you have to be crazy enough to take that risk, first of all, right? And but those are the situations where you can have very interesting opportunities, basically.
And has it paid off?
I hope so. It's doing very well. We've been spun off 2 years ago. We've novated all the contracts, novated more than 100 AI engineers that we have sitting in London. And the company is growing. The business is growing nationally as well as internationally. So it looks very good.
Very interesting.
We've done multiple follow-on rounds after that.
You know, I'm so surprised to actually hear you say that. It does make sense now that you've framed it in that way, but it surprises me because most people, when we talk about family offices, we think of slow, traditional, conservative, not risk takers.
Yeah.
Is that because you and NOIA Capital are different? And well, let's start there.
Yeah,
are you different?
That's how I describe it. So when people ask me who are you and what do you do? I say we're a multifamily office, but as opposed to other multifamily offices, almost 80% of our capital is internal.
What does that mean?
Meaning it's our own money.
From your own, the partnership?
From the partnership. So it's
80%?
Almost 80% is our own money. So
and 20% is coming from like 200 families?
Almost 200 families.
Wow.
Yeah,
so
exactly.
Jerome is incredibly wealthy is what you're telling me.
So it's Jerome's and my money, basically, that is invested first and foremost.
Wow.
And then you have basically all the other families that are invested in either of the verticals, right?
Okay.
So it's a multifamily office, but it's with a high portion of internal capital, which already is odd, basically. Generally, multifamily offices will have very little internal capital because it's going to be 4 or 5 large families that they're managing on behalf of. So that's point number one. Second point is, generally, family offices will have one patriarch, one leader, one guy that had made the money or lady that had made the money. And that person will basically be in their 60s, 70s, 80s, whatever, age. And they will, their aim and focus will be capital preservation to make sure that money stays around because it had been earned with hard sweat and tears basically over years. And the idea is to have that preserved, right? In our case, again, very odd, Jerome is 40, I'm 45. So because of that, we're basically thinking, hopefully, inshallah, that you have a long time in front of you to actually compound capital. That's why our strategies are designed in a way where we actually can grow the capital aggressively rather than just focus on capital preservation, basically.
And does that mean then, when you look across the family offices that have invested with you, they're a younger family offices or risk takers?
No, it's a mix. It's a mix because they don't. The families, the other families, haven't given us their wealth. We're not managing their wealth. Basically, they're just investing in either of our verticals with a portion of their capital.
I see.
So we have families that are very conservative, but they think and they actually think, for example, for our digital asset vertical, which is one of our flagship verticals. Generally we have even families there that will be like, I don't understand digital assets. I don't believe in Bitcoin. I think it's all Fugaza, whatever. But I might be wrong, so I'm going to invest.
Interesting.
Right? So it's like, and generally these are obviously the best investors, right? In a sense of guys that will say, I might be wrong on something. And to hedge myself being wrong on something, I will put some money down with someone that seems to know what they're doing, basically. In that
intelligent and wealthy, right? That you have enough money that you can really put something considerable behind something that you might think you are convinced you're going to lose.
Yeah, exactly. Yeah.
And What percentage of the families you represent, the family offices that invest in your funds, have invested in the digital assets and crypto space?
In the digital asset fund, I think we have, I'm not 100% sure, I think we're 130 families approximately we have in that fund. Yeah.
That's fascinating.
Yeah.
So these old conservative family offices, they are actively investing in crypto.
Yeah, they are. And I think more so now, especially given that, post-Trump's election, it's kind of become kosher, so to say, to be in digital assets, right? Whereas before that, in 2017, 2018, 2019, if you had told anybody that you were active in digital assets or investing in digital assets, they thought that either you're a crook or you're clueless, basically, right? So
absolutely. I mean, some people may still think that. But
yeah, but now with the 100 billion plus in ETFs, in Bitcoin ETFs alone, clearly, if someone still thinks that, they're just living behind the moon, basically, right? I mean, if BlackRock and others are running 100 billion, it's the largest ETF they have themselves in their portfolios.
Their
basically.
Largest ETF is their digital.
It's not the largest right now, but it's their fastest growing ETF.
Okay,
it's been their fastest growth to 100 billion.
Wow.
I mean, some of the S&P ETFs, etc., are still larger.
Of course.
But in terms of a single asset, I think outside of gold or with gold, it's the largest ETFs.
And
basically.
so this ETF is pure Bitcoin, or it's Bitcoin and a few others, like
Ethereum? No,
Ethereum?
It's pure Bitcoin. So you have multiple ETFs that are out there, I think 8 or 9, that are just tracking Bitcoin, basically.
Interesting.
Yeah, Fidelity has it, BlackRock has it, and many of them have it. Yeah.
Muhammed, I know you're such a fan. I can call you a fanboy of crypto and Satoshi Nakamura's whole thesis. Tell me a little bit about where this passion came from and what you really believe digital currencies are going to do for the world.
I think digital currencies, but especially, I first of all, I want to separate it, right? So you have to separate Bitcoin from digital or from cryptocurrencies, right?
And sort of crypto projects.
Or crypto projects, right?
Okay.
Everything outside of Bitcoin basically has a management team, has a marketing department, has a business model, and is trying to
They're startups.
Yeah, they're startups, basically.
Yeah.
I mean, not all of them are startups anymore, because there are some of them that are, in the tens of billions and hundreds of billions of value.
Right.
Right. You can't call Binance a startup anymore, but it has a token.
But it was a startup.
But it was a startup in 17. In fact, it's probably one of the fastest company to go. I think it was the fastest company to go to $1 billion of profit, not necessarily of value, right? Because if you go in the startup world to unicorns and you say, oh, they're now a unicorn, company might still only have 10 million revenue. In some cases now in AI, they still don't have any revenue, but someone is valuing them at $1 billion already or plus, and they become unicorn status, right? Like some of the offshoots of OpenAI, they just started with a team and they were already raising at 2 billion value or something, right? So that's, in my mind, that's impressive. But it just shows potentially also the froth that is in the markets in certain areas of the market, which is way more impressive is for you to start a business in 2017 and then in 2019 to write $1 billion of profits.
Absolutely.
And that
was the Binance story.
That's what Binance did, right? So Binance started, and I don't remember exactly the month because, I had looked at this, but it's been a while now. But I think within 24 to 36 months, it wrote $1 billion of profits. And that's real unicorn status, basically. Because when you wrote $1 billion of profits, first of all, you're worth minimum 10, at 10 times earnings, but more like, maybe 50 at 50 times earnings, basically, given how strong your growth is. But so I think it almost redefined the term, unicorn status, basically. Anyway, that's a different topic. We just kind of digress now. But coming back to cryptocurrencies, I separate Bitcoin and I separate the other projects, basically, like I said, right? Bitcoin has no management team, has no CEO, has no marketing department. It's completely decentralized. It's as much as a social phenomenon as it is a technological phenomenon, right? And crypto overall has the technological revolution with it that it brings with it, which is eliminating the rent seekers with the blockchain, right? Making sure that all these middlemen are not there or required anymore because you can verify everything using the blockchain, right? Simply talking. But Bitcoin itself brings a monetary revolution with it because it has all the characteristics of gold, which, we can, basically list them, what makes something money, basically, right? So it has to be divisible, it has to be unifiably understandable, like people need to understand what it is. It has to be a store of value, it needs to be a medium of exchange, right? So all these characteristics that you require for something to be money, right? So Bitcoin has all of them, exactly like gold has, which is why gold has been money for 5,000 years, right? And one of the most important characteristics there for gold specifically, for it to be having become money, and there was a famous YouTube video that I just watched yesterday from John Harris, this guy that makes these explainer videos on YouTube, and he'd done a 35-minute video on gold, and I just thought he completely missed the point, because he was basically saying almost like, oh, it's randomly that that mankind had decided for gold to become money, and therefore it became money. That's not how it works. Nothing happens randomly because a group of people at some point decide, let's use gold, and then gold becomes money. Cattle was money. All sorts of other things were money before. The reason why gold became money is because of the characteristics that gold has. That's why we always say humanity goes to the hardest form, and the hardest form becomes money, basically, right? So something that is the easiest of divisibility, transferability, store of value, that's what becomes money in the end. There is a reason why silver is not money, and there is a reason why platinum is not money, and aluminium is not money.
Well, I was just about to ask you that.
Right?
Why wouldn't titanium then one day become money?
Because of the characteristics that you have to be required for you to be money. And you need to be widely available, but still scarce. So that's why some rare earth metals can't be money.
They're too scarce.
Yeah, they're too scarce. Or maybe they're even poisonous and you can't touch them or hoard them, or it's not easy to keep them, to safeguard them, etc. Gold has these characteristics of being anti-entropy, right? So it doesn't degrade, right? Gold, you can bury it in your garden, you can leave it in your cupboard, you can put it in your grave, you can do whatever you want, you can swallow it, it doesn't change its characteristics, basically, right? So that's one of the key reasons why gold has been money, basically. And
surely there must be some other mineral, I'm not a chemist, but I'm sure there's another mineral that could have all of the same properties of gold. As I feel into it, it feels like there is this element of humanity has decided that there is a real value on gold.
Of course.
And there's a sort of a perception side of it that has won the hearts and minds.
That's why I said it's as much as a social construct as it is a technological phenomenon for Bitcoin specifically. And it's the same for gold, obviously. But the people gathering around gold and using gold as money is not random. That's what I'm saying. It's those characteristics that make it happen. And there might be another metal that you said, like for example, silver almost has a lot of the characteristics as gold as well. But the problem is its stock to flow ratio. There is too much new silver coming out versus the amount of silver that there is. The inflation rate is too high, basically. And therefore, the store of value of silver isn't good enough. Copper has almost the same characteristics of gold, and it was used as money, and we still have it in coins, etc., right? But you can't, it's not as good as a store of value as gold, because again, there is too much new copper being found versus the stock of copper there is out there in the world, right? Gold is inflating at almost around 2.5%. We don't know exactly, but we know it's not 20.
Yeah.
And we know it's not zero, basically, right? So that's why it's scarce enough, widely available enough for it to have the characteristics necessary to be a good store of value, basically, right? And that's what makes it happen. So in very simple terms, Erica, we say gold travels perfectly over time. Which is very important for you to be a store of value, because money needs to be from the...
Stable.
Yes, it needs to be stable, right? So it really travels well over time, but it travels horribly over space. What that means is you can't take your gold bars and you can just go from here, like you've been to Jordan last week, and you can just go to Jordan with it, because someone at the border will tell you, Erica, why is it that you have 20 gold bars with you? What are you doing here? You can't. It doesn't travel well over space, basically.
And why is that important?
It's important because in the 21st century, for something to be money and to be taken as money, especially deflationary money, which is what gold is, not inflationary money like dollars or euros or dirhams
That
and
loses
others.
value
that
over
loses
time.
value over time. In the 21st century, the world has become a village. We're transacting with everyone and anyone globally, right? You have a person in your studio that cuts the videos for you and might be sitting in the Philippines, right? Or might be sitting in Indonesia.
Yeah.
Exactly, right? So you need to be able to pay the person. That person needs to be able to trust that the money they receive from you is the right, is not counterfeited. It's the right amount. It's the same censorship-resistant capital that they would like to transact with, basically, right? In the old days, you didn't require that because commerce was local, so gold was good enough. You had at the Prophet Muhammad Sallallahu time, you had the caravans leave Mecca or Medina,
As long as your
and they would go to
camel
Damascus
and your horses could carry it.
Correct, exactly. And they would give the gold coins and they would take the goods and they would bring it back to Medina, for example. And that was the transaction, right? That was the spices would travel from Baghdad, let's say, to Medina, and that would have been the transaction, right? In this current day and age, you require money to be able to travel safely over time, but also over space.
Yes.
And that's what Bitcoin achieves. Because Bitcoin doesn't degrade, exactly like gold. It doesn't lose value, exactly like gold. It's always 1 Bitcoin equals 1 Bitcoin because it's 21 million limited, basically. It's scarce, absolute scarce, which gold is not, right? And at the same time, it travels perfectly over space. I can send a Bitcoin with a lightning transaction from here to Indonesia in a split second, basically, right? So that's really, in my mind, that's why I'm separating the two. That's what I'm really excited about, because that allows us to re-establish sound money in the world. And the world requires sound money for a very simple reason, which I will explain now, Erica. The internet initially has democratized information.
Yes.
We went onto the internet, the person in Indonesia, the person in Jordan, the person in Germany, which is where I'm from, they would go onto the same website, they would see the same information, they would have access to the same knowledge. That's what the internet initially did. After that, in the second stage, with all the new tools that have been built on the internet, from the Udemys, the Coursera's, the YouTubes, etc. of this world, what has happened is the internet has then democratized knowledge, right? Not just information. Now you can do your MIT course, your Harvard, whatever course, your executive MBA, whatever, all online, basically, right? And you can be as good or almost as good as the person that is at Stanford University in California,
100%.
basically, right? So that's the next level. The third level that we are not there yet is the democratization of cost of capital. We're not there yet, but that's exactly what's going to happen. Once everyone is connected and they have the same information, and then they can actually democratize knowledge, and they now have the ability to have the same knowledge no matter where they are globally. The next ability is for you to have these connected persons to actually transact with value with each other on something that is, understandable globally, and that democratizes automatically the cost of capital. Right now, you have on your podcast all these things about African venture capital and Asian venture capital and Middle Eastern venture capital, etc. I saw them when I was going through. And, all of these guys that are doing something in Nigeria, doing something in Kenya, doing something in Indonesia, right? They need to have a return that is north of 30, 40, 50, 60% for the investors to say, I've actually ended up making a positive return on this investment, because the cost of capital in these countries is north of 15, 20, 25%, basically, right? It's not like in the US, 3%, or like in Germany, 5%, 2%. It's not single digit. The cost of capital in the world is completely different. If you have Turkish lira depreciating at 50% a year, the cost of capital for you to start to fund a startup business in Turkey that's supposed to come up with an idea from Turkish lira income, you will tell the person look, I need to make, because it's losing 50% value a year, right? So I need to be making a real return here, much, much above the 3 or 5% that you would have in developed markets, basically, right? That's what's going to get democratized now, basically.
Because of Bitcoin.
Because of Bitcoin. Because I believe that the world is going to, and we need this, because fiat money causes the split between poor and rich to just become larger and larger and larger, right? And I think the world is waking up to it. And I think one of the reasons, which is very interesting, is why gold has been up so much this year, is in this multipolar world where you don't have one power anymore, like the United States, that calls the shots and everybody says, yes, I, sir, which is basically where we were post the gold standard. Don't forget, this is only a 40-year experiment. It's only in 1971 that Nixon came out on a Sunday and de-linked the US dollar to the gold, right? Up until then, for every dollar, you had a certain amount of ounce that you could get gold back if you brought that dollar to the bank, basically, right? So the delinkage of the dollar versus to gold only happened in 1971. So it's like what? It's 50 years, right? It's a 50 odd year phenomenon that we are talking about, basically, right? And I believe that, if you look at the history, and there's a lot of books on this, right? The one author that I really recommend everybody to read is, I was actually with him in Lugano this weekend. It's Saifeddin Ammous. He basically wrote the Bitcoin standard, the fiat standard, and the principles of economics. He has 3 books. He has a 4th book coming out now called the Gold Standard. And he goes in detail into all of these things, basically, in great detail, right? And that's what I believe the world needs to go into, meaning we need to leave this Keynesian world, which there's only 2 ways of managing the economies of the globe, basically. It's the fiat Keynesian world or the Austrian school of economics, not the Keynesian school, but the Austrian school of economics, which is more the sound money guys, basically, that believe in deflationary money. Money has to increase in value over time rather than decrease in value over time. And I think the world has now figured out, or is figuring out as we speak, in the last 50 years, basically, that this is not going to work. This is not working. That this is making the poor poorer and the rich richer. And then it's the other way that you need to look at for the other system. My son, I had spoken to him yesterday. He's right now he's studying in the south of France, but with some of his college friends, he just went to Tunisia, and he was telling me, Dad, it looks so poor. It's such like he was shocked. He had never been to a country that was similar to that. And I was basically telling him this is exactly what the fiat system has brought us, basically, right? I've been to Egypt a few years last summer, and I hadn't been to Egypt for 20 years, 20 odd years, right? And in those 20 odd years difference from my university years to now, I didn't see Egypt as having improved, basically, right?
Yeah.
And that's the clear examples. And I'm not picking on countries here, right? Turkey is the same, Brazil is the same, Argentina is the same, South Africa is the same, Pakistan is the same, Nigeria. It's this constant global south, begging for a bailout, and then trying to recover from it, and then begging for another bailout, and trying to and in the same system just getting worse and worse and worse, and the hurdles for them to jump over it just become larger and higher, basically, right? So
if this is your vision, Muhammad, do you see countries actually adopting Bitcoin as their currency going forwards? Is that how you see?
Yeah, I don't think they have a choice. I I think. Right now, what's happening is, as it is with many things, Erica, you should never expect some changes from the top down. Change always happens from bottom up, right? More and more people in Turkey. Turkey is one of the largest crypto markets out there. It's I think 4th or 5th market right now globally. Why? Because people get their salaries. They see that their currency is losing 10%, 5% of value a month, and then they're like, immediately when they get their salary, they go and buy either Tether, meaning USDT, so stable coins, or they go buy Bitcoin, basically, just to have something.
They don't buy US dollars?
Or USDT is US dollars, right? They just, on the app, they just do it with
digitally,
Tether, digitally. The old school guys will go to the bazaar and they will buy gold, basically, right? Or they will buy dollars, right? They will exchange their Turkish lira in dollars, right? So I meant the new generation, right?
Yeah.
So That's already there. You already have 20 million plus cryptocurrency accounts in Turkey out of an 85 million population, basically,
Wow.
right? So change doesn't need to happen necessarily top down. It starts happening bottom up. Until then, an elected professional comes to the top and either is a Bitcoiner himself or either has gone through these problems themselves and then realizes it. And then a change happens, kind of slowly and then gradually, but then almost all of a sudden, so to say, right?
Fascinating. And I love it. You're such an enigma, Muhammed.
Enigma, yeah.
You're an enigma.
No, thank you.
A family office CIO, obviously a risk taker, and here you are, like a huge proponent of crypto, and particularly Bitcoin. And I really love that decentralized, the passion you have for where things are going. So, Muhammed, as you know, the show is called The Perfect Pitch.
Yeah.
And there's obviously a lot of investors that tune in as well, but there's a lot of startup founders that tune in to really understand the minds of different investors. And you're the enigma I just mentioned. So I want to ask you personally, when a startup founder reaches out to you and potentially sees that there might be an investment there, what makes for a perfect pitch for them, for you?
To be very honest, Erica, I think the best pitches that we've seen is when the individual or the individuals, you can just feel their passion for their project and their relentless drive, basically, to solve that problem, right? And you can feel when someone is doing something purely for the monetary aspect, and then you can feel it when someone has really just, blown their own mind and got completely obsessed with solving that specific problem, right? I had so many examples of my own, basically, of businesses that I thought were not going to work, and then because the founders were so obsessive about it, they basically figured it out, and then it became successful businesses, right? I have zero, being in public markets for 20 plus years now as a fund manager, as an investor, etc. You need to remember, Erica, that equity fund managers, they're only 60% of the time right. So 40% of the time, even more than 40% of the time, you're wrong, right? So at SAC, they were measuring our hit ratio. Hit ratio was the number of ideas you got right versus the number of ideas you got wrong, basically, right? Long or short. And I was at 59.2%, which put me into the top 5 percentile of the firm.
Wow.
Out of 108 PMs, right? Now, there were other PMs that were better in other stuff, but on the hit ratio, I was on the top 5%, basically. Now, what that means is, at 59%, I'm in the top 5. Which means at 41%, I'm still wrong, basically, all the time. At
and there's
40%.
A bunch of fund managers that's probably half-half.
That's probably half-half, right? So if you're at 51, 52, 53, that's where the industry average is, 52.6 or 52.8 or something, right? So almost half, you're always wrong, right? So, and that's how I approach life, basically, right? If you always think like, oh, I'm right, I know this, I figured this out, etc. That arrogance, which is what blinds you, that arrogance that doesn't allow you to actually see the picture, right? So you always have to think, where can I be wrong, right? And just because I don't understand something or I don't like a pitch from a startup founder, it doesn't mean that the idea is bad or that the founder is not good enough, etc. It could very well mean in 40% of the cases that I just didn't get it, basically, right? So that's why I'm not, the only thing I can tell you is that there is certain things that we require for us to consider the pitch. And those are just things that we have put ourselves to just say we have to filter somewhere, basically, right? To have some sort of filtering mechanism so that we can decide where to continue to look, etc., right?
And what are those things?
Yeah, so one thing, for example, would be what I would call deal killers is if the person has more than one hat on, right? If the person says, oh, I'm involved in this pitch and that's what I'm raising today from you, but I'm also the founder, and a bit like the Elon model, I would say, right? So you have run 5 businesses at the same time, right? There's only very few people on the planet
who can do that.
Who can do that, basically, right? And it might be that the person that comes to us is that person that can do it. I just don't want to take the risk, basically, right? Because the risks of our incentives not to be aligned is just too high. For him to say, oh, this one is not working anymore, let me just continue focusing on that one, and me being the one that is being dropped off, basically, is just too high. If we're putting our hard-earned assets into an idea, and it's your idea, then if I lose my wallet, you need to lose your shirt, basically, right? So it needs to be like that.
So singularly focused.
Singularly focused.
Obsessed about your idea.
Correct.
What else?
Been doing nothing else,
besides the startup.
Than that startup.
Yeah.
And then for us, more important than the idea, because we always say, execution, an idea is not worth anything without execution. Being able to show us that the MVP is there and the traction is there, meaning that the market agrees with your idea, right? Because again, you can have ideas and you can have the best pitch book or the best PowerPoint slides, and if you can't prove to me that the market agrees with you that that this is going to be an idea that will
people are willing to pay for.
Then if the MVP, so to say, is not there, the minimum viable product, if that's not there, then we will have a very hard time backing it. I think right now that we see very clearly, I want to make that very clear. There's two types of founders that we see right now. There's one type of founders that use all the tools available to them, and they test everything all the time, and they don't require any money for testing all these things, and they go and do interviews, they go and test people, they do dummy websites, they just code with very, very rudimentary products and just to test their idea out, basically. And then they'll come with you with data and say, look, I've tested it and it works, and now I want to scale it, basically. And then there's these other guys that make shiny decks and shiny teams and everything, but they're not willing to actually test their stuff. And then they're waiting for someone to give them the money to pay their salaries, to make them comfortable, to be able to then test their idea, right? And that, I feel, is the two worlds that are clashing right now, right? If you want our money to leave your current job, we're the wrong capital, basically, right? In a sense, you need to be obsessed enough with that idea and convinced enough that that idea will work by having done all of these things that you can do without capital today, basically, right? Almost without capital today, right?
Yeah, I can understand that from an investor point of view, because if you haven't left your job to do this, it means you might not have the conviction in what you're trying to sell and get other people to financially back.
Correct. Yeah, and those two founders are very distinct from each other. One is basically constantly validating what he's thinking or she's thinking, and is trying to prove it with data, whereas the other one is just making big assumptions and is hoping for some group of investors to put $5 million down, X million dollars down, for them to try it out, basically, right? Which is very, very different. Like in this new world, you don't need this anymore, right? You can easily start, use social media. You can have others that have groups where you can ask people questions to understand, to say, if this service would be there, would you use it, right? And then you can have a website that you can create. Lovable is the best example, right? A company that went from 0 to 100 million ARR, I think, in 8 months, if I remember correctly. You can basically just vibe code, right? You just chat to it and it codes for you, right? So, but it's perfect stuff that you can use those tools to just test stuff, right? To come up with products that people can use, basically, and test, right?
Beautiful.
So,
okay, and in terms of...
We see that very clearly still, like this kind of two worlds, like this AI, so to say, maybe you want to say, maybe like the AI enabled founder that is already thinking that way and tests everything and only comes with data. Whereas the other founder that is hoping for someone to pay for his convenience so he can try something out, basically, right?
Right. Yeah, that makes sense. And so I would assume that latter bucket is your pet peeve of those types of founders trying to find you out, look for you. You mentioned earlier to me before that you do invest later stage, so it's beyond the MVP. There's traction. You're looking for the 30 to 300 million valuation range of a company. So that's a little bit more mature.
Generally, that's just, exactly.
So you're looking for companies that probably have had a bit of investment before or have had a few years of really building something sizable. And in the last 5 years, you've done about 25 deals. It's global. You're sector agnostic as well as regionally and geographically agnostic.
Yeah.
And
what we do is basically tech-enabled businesses, right?
Yeah.
We want scalable stuff,
Yeah.
right? We're looking at scalable things that are out there.
these are not brick and mortar barbershops or
exactly,
restaurants.
exactly.
Got it. And 4 out of 25 of your deals have been from the region.
Yeah, we had 4 deals that we had here in the region. Again, not because we were trying to invest in the region, just because interesting stuff is happening in the region, right? I mean, I don't know. I'll give you an example. One company that we backed is Applied AI. I don't know if you heard of them. If not, you have to basically. Arya, the founder, he's done the region's largest Series A at 355 million value. He's raised, I think, almost $60 million.
Wow.
And which is the largest Series A in the region. And at the same time, it's one of these examples of a global business being built out of the region. Abu Dhabi headquartered, but San Francisco offices, Berlin offices, So very, very interesting business that is being built out of this region, basically, with a hell of a cap table. It was the first investment in 5 years that Palantir has ever made.
Wow.
Yeah, so that's like a great achievement in itself.
Yeah,
basically.
a little jewel in the crown.
Exactly.
Mohammed, I feel like we could talk forever.
Yeah.
I really, really appreciate your time. We'll have a link with the show notes and your profile so that startup founders can find you on lucidityinsights.com as well and start pitching their strong MVPs for you. And I just really want to thank you for your sharing of your wisdom, your knowledge. It's just such a pleasure to sit with someone who seems so multidimensional, so knowledgeable, so passionate about what you're doing. And I really thank you for your time.
In Turkey, we say "O senin gözlerinin güzelliği," which means like that's the beauty in your eyes. There's not much that is on my side, basically. So
There's
I
an
thank
Arabic
you
term
for
as well.
I thank you for having me on the show. Really
Thank
exciting.
you.
Thank you.
Hey there. Thanks for joining this conversation. If you enjoyed that episode and you want to start researching potential investors for your startup's fundraising strategy, go to lucidityinsights.com and sign up now to the startup registration package by clicking the plans button on the top right corner. We look forward to having you join our future conversations and checking out our additional content. Until next time, stay hungry and stay humble.